Hey there! Welcome back to Legend Finance, your trusted hub for all things money. If you're new here, don't forget to click that subscribe button and ring the notification bell so you'll never miss any of our future finance talks. Today's topic is an intriguing one that I'm sure many of you have pondered over: trading versus investing. These terms are often used interchangeably, but there are key differences that can significantly impact your financial strategy. So grab your coffee, settle in, and let's dive deep into this money mystery. Definitions. You might be wondering what separates investing from trading. They sound pretty similar, right? Well, investing is like planting a seed and patiently waiting for a tree to grow. It's about putting your money somewhere and hoping it'll grow over time. On the other hand, trading is more like a quick game of buy and sell. Traders look to make a profit by frequently buying and selling stocks, taking advantage of market ups and downs. So in a nutshell, while investors bet on long-term growth, traders ride the waves of market volatility. Key differences. So being a trader can take on different meanings. Some firms employ traders to help them get the best prices on their chosen investments. But today, we're chatting about traders who are in it just to grow their own wallets. They differ from investors mainly in two ways: when they trade and how they analyze stocks. Investing is a marathon. You're banking on a company's growth over time, maybe even years. Yes, daily stock prices can dance around a bit, and some investors do buy when prices dip. But once they buy, they're usually in it for the long haul. Trading, though, is more of a sprint. Think of day trading, where folks buy and sell stocks within a single day, or swing trading, which might stretch over a few weeks or months. All trading styles generally work within short timelines, some even in seconds. Traders thus make more trades and juggle many positions. But don't get it twisted, just buying and selling quickly doesn't make you a trader. There's also the analysis part. To understand how traders and investors analyze a company differently, we first need to clarify the difference between a stock's price and its intrinsic value. The goal of investing and trading is the same: to make money. Both investors and traders do this by opening accounts so they can easily buy and sell assets like stocks, bonds, and mutual funds, among others. Both investing and trading come with the possibility of risk and reward. After all, there are no guarantees in life, including in the markets. Although the degree varies, every asset comes with the potential for loss the same way they promise big gains. Stock prices just reflect what buyers and sellers are willing to trade at right now. But beyond that, there's an intrinsic value or real worth of the stock that, ideally, the price should reflect over time. Of course, human emotions like fear or greed can make the price deviate from its true worth. In the investing world, people take two stances. Passive investors ignore short-term price movements, betting on the long-term growth of the stock's intrinsic value. Active investors try to estimate this intrinsic value to buy stocks when they're undervalued, hoping for profit when the price corrects itself. Traders, though, aren't concerned about intrinsic value. They're in it for the price swings, often not even caring what the company does. Their analysis focuses on technical indicators, looking for trends or patterns they can exploit for quick gains. Now, some traders do use company news to anticipate short-term price shifts, but their focus is usually narrow, not aiming to understand the company's full story. Trading demands a different mindset. It's fast-paced and competitive. Some might say it requires a bit of bluffing, trying to hide your real intentions to get the best price. This thrill of fast trades and quick payoffs can lure young investors in, especially with all those ads showing millionaires who supposedly made it big trading. But trading carries high risks. Traders often invest a lot of money in each trade, sometimes even borrowing to boost their returns, which exposes them to short-term volatility. It's also time-consuming and labor-intensive. And to be honest, as a novice trader, you frequently lack the resources, superior research, and algorithms of professionals. Sure, you can make money trading, and some do it full-time from home. Some companies even hire salaried traders, so it's not all bad. But trading is like poker. There's a lot of chance involved, and often the odds aren't in your favor. So most advisors would recommend investing for the average person. By researching thoroughly and holding for the long term, you can benefit from the broad growth of the economy and the stock market as a whole. Sure, it may not be as thrilling as a high-risk bet, but that's probably a good thing. After all, if you're after high-stakes thrills with not-so-great odds, you might as well hit the casino. At least you'll get free drinks. What's more profitable, investing or trading? There's no one-size-fits-all answer here since it all comes down to you and your finances. If you're someone who's clued in about market workings and can stomach some risks, trading might be your game. You won't lose sleep when the market dips or if you suffer a loss. On the other hand, if you prefer to play it safe and protect your capital, investing is probably a better fit for you. Is trading harder than investing? Trading, in essence, presents a higher degree of complexity than investing, largely due to its intrinsic characteristics. It requires individuals to keep a constant, vigilant eye on market movements, changes, and trends. Traders need to be well-versed in interpreting and responding to market signals, economic news, and other relevant data. In other words, it's not a casual endeavor, but one that requires substantial time commitment and dedication. Understanding how different assets and markets operate is an integral part of this process. Knowledge of various financial instruments, their nuances, and how they interact within the broader financial ecosystem is key. Traders deal with a wide spectrum of assets, which could be as straightforward as stocks and bonds, or could involve more intricate financial instruments. Futures contracts, for example, are more complex trading vehicles. These contracts involve an agreement to buy or sell an asset at a future date at an agreed-upon price. Trading in futures requires a deep understanding of the product, the market, and the potential risks and rewards. Similarly, swaps, another form of complex financial instrument, involve an agreement to exchange the cash flows or returns of one asset for another. Knowledge of these financial instruments is a significant aspect of a trader's toolbox. In addition to the intellectual and analytical aspects, trading also involves a heavy psychological component. Unlike many investors who adopt a more passive, long-term approach, traders are actively engaged in the market's ebb and flow. This active engagement often means that traders are exposed to more frequent ups and downs, which can take an emotional toll. Large losses, in particular, can be challenging to bear. It's not unusual for the market to take unexpected turns, leading to substantial financial setbacks. For traders, these moments can be nerve-wracking. The ability to manage emotions and maintain a level-headed approach during these turbulent times is crucial. It's about balancing the fear of potential losses with the greed for potential gains, and this emotional equilibrium is often what sets successful traders apart. In conclusion, trading is an intricate and dynamic process that combines elements of knowledge, time commitment, and psychological resilience. It's not for everyone, but for those who can master these aspects, it can provide a rewarding, though challenging, financial journey. Are they the same thing? Although these terms are generally used interchangeably, trading and investing are not the same thing. Trading involves buying and selling assets, such as stocks, for short-term gains. Traders primarily focus on share prices as they make their decisions. On the other hand, investors focus on long-term gains when they buy and sell investment vehicles. You know, it's super common to hear folks throw around the words investing and trading as if they mean the same thing. And honestly, who can blame them? When you're just getting started, they kind of look similar. You open an account, put some cash in, buy something, sell something, and hopefully make a profit along the way. But here's the inside scoop. They're not identical twins. They're more like distant cousins. Let me explain. When you're an investor, you're in it for the long haul. You are the tortoise in the race, moving steadily and oblivious to any bumps in the road. You're willing to wait, think years or even decades, to see your investments grow. You're also the type who likes to play it safe, spreading your bets around to minimize risk. On the flip side, traders are more like rabbits, hopping quickly from one thing to another. They're adrenaline junkies who love the fast-paced, high-risk game, making quick decisions based on the mood of the market that day or even that hour. Now, don't think that being a trader is all about luck. Far from it. Traders are usually pretty savvy about how the market works. They're like detectives, looking for clues in market trends and financial data to decide their next move. Meanwhile, if you're an investor, you're more of a philosopher, thinking deeply about a company's overall health, its place in the market, and its potential for long-term growth. Here's the key takeaway. Whether you decide to be an investor or a trader, know that both paths have their rewards and their risks. Each has its own set of rules and requires a certain mindset. Choose the one that feels right for you based on your goals, your risk tolerance, and how much time you want to put into it. Remember, as an investor, you're playing the long game, banking on steady growth over time. As a trader, you're on the lookout for short-term opportunities to profit from the market's ups and downs. Both require a solid understanding of how markets work and a game plan. The biggest difference? Investors need patience and perseverance, while traders need agility and a good sense of market timing. But hey, whether you're a tortoise or a hare, there's a place for you in the financial world. Thank you so much for hanging out with us here at Legend Finance. We just wrapped up our deep dive into trading versus investing. Hopefully, you're walking away with a clearer picture of how these two strategies can play out in your financial journey. It can seem a little complex, but don't worry. That's why we're here, to help make these financial waters a little less murky. If you enjoyed the video, give it a thumbs up. Your likes let us know that we're on the right track. And if you haven't already, click subscribe and turn on notifications so you won't miss our next financial deep dive. And as always, stay legendary.